All right, let's jump right into this explainer with a story that honestly sets the stage perfectly. Picture this. A 10-year-old boy is wandering around the Oxerbin horse racetrack in Omaha. But he isn't there to watch the races. Nope. He's there after the races have finished. Young Warren Buffett would walk the grounds picking through literally thousands of discarded betting tickets. Why? Well, because he already understood human psychology. He figured out that people go to the track, they drink, they celebrate, they get super distracted, and inevitably, someone accidentally throws away a winning ticket. So young Warren would patiently sift through those thousands of thrown-away tickets, hunting for the discarded winners. And get this, he'd take those winning tickets to his aunt, who would cash them in for him at the counter since he was just a kid. What this early story proves is that finding value where others literally see trash requires a very specific mindset. It takes patience, intense observation, and a willingness to do the boring, tedious work that everyone else is just ignoring. This wasn't some childhood game. This was the foundational mindset of the world's greatest investor. Phase 1, mindset and discovery. To train your brain to actually spot those great opportunities, we kick things off with rule number 1, compounding knowledge. We talk a lot about compounding money, but compounding knowledge, that is the real secret engine. When Buffett started his investment partnership at age 20, he didn't have fancy screening software or high-speed internet. He spent entire days reading tiny, microscopic print in Moody's manuals. He looked at the raw financials of 5 or 6 companies jammed onto a single page and just read them cover to cover. His advice is simple, but honestly pretty brutal. Read 5 to 6 hours a day, because the more you learn, the more you earn. You know, we really tend to overcomplicate investing. We think we need massive spreadsheets or a fancy MBA to be successful. But consider this. How did a class of 7th graders completely beat the market? Legendary investor Peter Lynch shared this phenomenal story in his book, Beating the Street, and it brings us perfectly to Rule 2, invest only in what you understand. These 7th graders built a 14-company portfolio for a school project, and the results? Absolutely staggering. Over a 2-year period, these kids crushed the professional market. Their portfolio returned a massive 70%, while the S&P 500, which is the benchmark for the entire American stock market, only grew by 26%. They didn't have driver's licenses, they didn't have advanced degrees, but they absolutely destroyed the index funds. So how on earth did they pull that off? They did it because their teacher gave them one brilliant, unbending rule. You must be able to explain what the company makes or does easily. The standard was incredibly simple. If you can't explain the company's business model with a crayon, you are not allowed to invest in it. Whenever a student proposed a stock, they had to stand up and answer exactly what product or service the company offered. If they couldn't explain how the company actually made its money, the stock was rejected. It just goes to show you, you don't need a finance degree to be a great investor. You just need common sense. And that ties perfectly into Rule 5. Peter Lynch illustrated this wonderfully again. He noticed that his daughters all wore clothes from the Gap, a stock that had surged 13 times in value in a single year. It was a massive trend that he completely missed, despite it literally living in his own house. Vowing to be a bit more observant, he later took his daughters to the mall. Instead of the Gap, he noticed they made a beeline for a packed store called The Body Shop. He saw women crowding the aisles, buying lotions and creams. The very next day, Lynch got the annual report, saw they were profitably expanding worldwide, and recommended the stock. It multiplied in value all because he paid attention to what real people were actually buying.
We actually see this exact same phenomenon play out in the Indian market, too. Think about Royal Enfield, a brand people are absolutely beloved for its iconic bullet bikes. People didn't just buy these bikes, they were completely obsessed with them. If you had observed that real-world popularity and bought the stock early on, you would have seen its price skyrocket from a mere 1 rupee and 22 paise all the way to 25,525 rupees. That means every 1 lakh invested turned into roughly 20 crores. Incredible, right? And we see it again with everyday consumer goods. Take Britannia, a company that makes the biscuits almost every single household consumes on a daily basis. It's a product everyone instantly understands. An initial 10,000 rupee IPO investment in Britannia years ago would have steadily compounded to an astonishing 62 lakh rupees. Seriously, the best screen test for a stock is often just looking around your own house and your neighborhood.
Phase 2, the math of growth. So finding a popular product is just step 1. Step 2, finding aggressive growth.
This brings us to Rule 3, which highlights the massive growth advantage of small-cap companies over the long term. Let's look at the math for a second. For a giant like Reliance, which might already sit at a 16 lakh crore market cap, to grow 10 times larger, it needs to reach an almost impossible 16.6 lakh crore market cap. It takes a monumental economy-shifting amount of money to move that needle. But a small cap starting at just a 10,000 crore market cap, that can multiply to 20,000 or 100,000 crore much, much easier. And as heavyweights like Monish Pabrai point out, massive institutional investors actually face a huge structural disadvantage here. If you manage billions of dollars, you simply can't deploy your huge capital into tiny 10,000 crore companies effectively. If you invest 50 lakhs and it grows 10 times to 5 crores, that barely even registers on a multi-billion-dollar fund's balance sheet. Therefore, the big money naturally moves up to the giant companies, leaving the bottom of the market continually emptied out. This leaves incredible, explosive growth opportunities wide open for smaller retail investors who know exactly where to look. Okay, let's tackle the vital math behind Rule 7, free cash flow is king. Listen, it is so incredibly easy to be fooled by the earnings or profit line on a financial statement. Why? Because paper earnings can easily hide unpaid invoices, or they might completely fail to account for massive mandatory future expenses. Free cash flow is the actual hard cash generated by operations minus the capital expenditure, meaning the money the company actually has to spend just to keep the lights on and the machines running. Just look at this massive anomaly with Reliance back in March 2021 to see exactly why this matters. If you only looked at their profit and loss statement, you'd see a massive positive earning of over 49,000 crore. Huge success, right? But if you dug into their actual free cash flow for that same period, it was negative 13,523 crore. The cash actually sitting in the bank dropped significantly from previous years. Now, don't get me wrong, this doesn't mean it's a bad company at all, but it absolutely proves that you cannot blindly trust the top-line profit. Think of a business that makes 1 crore in profit, but requires you to buy a 99 lakh machine every single year just to stay in business. Your actual usable cash is only 1 lakh. When you see negative cash flow, you must read the annual reports and listen to the earnings calls to understand their capital expenditures. Are they borrowing money? Are they investing heavily in future infrastructure? You really have to do the reading. Phase 3, execution and psychology. Listen, you can have the perfect mindset and nail the math, but it means literally nothing without the psychological discipline to manage your wealth correctly. Rule 4 dictates you should hold a highly concentrated portfolio. The conventional wisdom out there is to diversify endlessly, to own hundreds of stocks. But this rule states you should hold no more stocks than you can actively remain informed on. And practically speaking, the human mind can genuinely only stay deeply informed on a maximum of 8 to 15 companies at once. If you own more than that, you aren't really investing, you're just collecting ticker symbols. Warren Buffett actually takes this extreme concentration even further. He says that if you can find just 3 truly super businesses over your entire lifetime, 3 companies that consistently perform exceptionally well, that is more than enough for an average person to achieve incredible financial success. You don't need 100 mediocre ideas, you just need a few brilliant ones that you hold on to tightly. To reach that level of concentration, your whole psychology has to shift. You need to research your stock picks so thoroughly that it feels like you've personally met the owner of the business, sat down at a table with them, and signed a binding 100-page long-term business contract. If you wouldn't feel entirely comfortable doing that, well, you probably shouldn't be buying the stock. And this kind of incredible discipline leads us right into Rule 6. Trying to predict when to enter or exit the market is arguably an investor's absolute biggest curse. Think about how much energy is wasted by 99% of the public trying to guess if the market is going up tomorrow or if it's going to crash next week. People are completely drained trying to perfectly time their trades. So instead of wasting all that energy guessing when the market might dip, focus entirely on buying great businesses that people genuinely love and need. Why? Because over the long term, stock prices will eventually, inevitably, mirror the actual fundamental growth of the business itself. If the business grows its intrinsic value, the stock price will naturally follow. Market timing is just a distraction. Business growth is the reality. So, to really evolve as an investor, keep these 7 rules front and center. Compound your knowledge. Know exactly what you own. Look for small cap potential. Keep a highly concentrated portfolio. Use real-world product popularity as a guide. Completely ignore market timing. And always, always remember, free cash flow is king. As we wrap up this explainer, I really want to leave you with a pivotal question. Take a hard look at your own portfolio today. Are you actually doing the reading to deeply understand the businesses you own, just like those seventh graders did? Or are you just gambling on a ticker symbol, crossing your fingers, and hoping the market timed it right for you? Keep learning, keep reading, and thanks for joining me on this deep dive.